Fast profits on stocks that are in trouble. So let me actually run through this quick presentation. It's really short, and then we're going to use the new distinction using IV percentiles, finding stocks whose options have IV in the top of their annual range. And why is that important? Well, it's kind of like ambulance chasing. We're going to look for stocks in trouble by detecting the stocks that have options approaching the high of a year. So IV over a year fluctuates, and we're going to find stocks where the IV is near the high of its annual range. That's a clear sign. Typically, it's a clear sign that the stock has tanked, that the stock's in trouble. Now, there are other scenarios where the IV could be high and in the high end of its annual range, and the stock is moving up on good news. And you're going to see an example of that here in just a minute. So here's an example of an IV chart. This is on AFLAC. It's a current IV chart. And you can see here, now this is not an annual chart, but at least over the last 6 months or so, look how high the IV is. Whoop, whoop, whoop. Ambulance chasing like lawyers in the States, when you get a speeding ticket or you get into a fender bender, lawyers will send you communications usually within 24 hours because they have reports that show all of us drivers that are in trouble. And so our report is high IV. And what's important to note about IV, which is you can consider IV the expense of the options. You can consider IV fear, a fear indicator, or a greed indicator. And you could also consider IV a fear indicator. Did I say fear already? So fear, expense. But the point is that IV ain't there for no reason. There's a reason that IV is elevated on this stock. And let's take a look at the stock. There it is. This is AFLAC insurance companies. Insurance companies take your money and invest it too. Probably, one would expect in government bonds. So that's a good opportunity. We'll take a look at the news on AFLAC perhaps. I'm going to show you how I found this one in just a minute. Here's another one, and there's plenty right now. PNC Financial Services. Look at this IV here. That's actually at the annual high of the annual range. Right at the high of the annual range. So you can see it right there, 100%. That's the highest it's been in the last year. What? Let's look at the stock. IV ain't there for no reason. There's a reason, and here's the reason. The stock is under duress like the rest of the financial sector. So how do you find these? Well, you got to have something. Well, I'll tell you how to find them in a minute. So here's the idea. We're looking for, this works best on bearish news, bad news. Badness, it takes a stock longer to recover from bad news than to drop perhaps after some good news. So I like the sweet spot in this strategy is bears. We want to look for high volume breakdown below support levels, couple it with some bad news, and then you sell a bear call spread at a resistance level or maybe several resistance levels above where the stock is. So we're going to look at one of those today, and then the bulls, just the opposite. You look for a high volume break above resistance levels, and then you look for some good news or some good reason for that to happen. And then you sell a bullish credit spread or a bull put spread at a support level, and preferably as many below the stock as possible to get about 1 percentage point of profit potential for every day of life in the trade. So that's going to be the strategy we'll apply. We did it last week as well, and this is just a different way to find them. What I like about this strategy, though, is that we're looking for where the IV is at the highest levels it's been within over the past year. So that's what's a little different about this strategy. You can find these very easily by going into the IV percentiles ranker in Tom's tools. And you can see here, and I'll go into here in a minute. I want to make sure you have the slide. So this is a slide that tells you what to do. Go after 7 to 30-day options, and then penny plus weekly. These are the defaults. Notice it's looking for the number of calendar days used over the past 365 days. All right, then you click search, and you're off to the races. So let's go do that real quick here. I'm going to go ahead and grab this one. Here's how you find it. You go to options, rankers, and there's others here we'll talk about perhaps later, but options, rankers, IV percentiles. And there's the same screen I just mentioned, and just hit search. And we can take a look at some of these, and perhaps we'll see some opportunities. Well, I know we are because I've already run it. There's plenty of opportunities at the moment. Here's Aflac. You got this, the chart, the pick, if you want to see the pick of the chart, there, the IV in this case, got that, look at that delicious IV. We want to sell some of that. The date of the next, you got news, date of next earnings, the closing price, and then the 7 to 30-day IV percentile. So these first 5, and notice gold's on the list here. What? Gold's on the list. Why is gold IV high? We're going to look at that in a minute. That's interesting, huh? Stocks setting, new highs, and the IV is going along with it. Why? IV ain't there for no reason. Why? Maybe while I'm going through the rest of these results here, if you have an opinion about why the IV is so high on gold when gold is rising, here's the chart of gold. Click chart. There's gold rising. Overlay the 7 to 30-day IV. Click update. What? That's not how it normally works. IV is rushing along with gold. Why? What do you say? I'll come back to your answers here in a few minutes. Why? Why is that happening? Okay, so then you have this, the 30 to 60, 60 to 90, and greater than 90 percentile. And, you want to take a look at maybe across the board, but MetLife, all these top 4 here have 100% over 7 to 30, apart from Aflac, 100% IV over 30 to 60, and then 60 to 90 and greater than 90, and then everything from 7 to 149 days. All of them, with one slight exception, are at high IVs across various timeframes. Remember, the IV is going to be different depending on the expiration. So when I see that even IV on options on, let's say PNC Financial Services, greater than 90-day options are at a 100% high. What could we do with those? Could we do long-term credit spreads, 90-day credit spreads, and sell options that are at an annual high in terms of expense? Yes, we could do that too. So this is valuable information. And what you can do from here is we could take the top 5 here. These top 5, all of them, with a slight exception for Aflac 30 to 60, but pretty much across the board, the IV is the highest it's been across various timeframes over the last year. So let's save those top 5. These are the stocks that are either in really bad trouble or really good circumstances. Couldn't think of the right word. So what I want to do here is just save the top 5 highest IV stocks into my stock list. And then from there, I can go to searchers. Actually, let me go to a different chart here. I can go to searchers, single strategy. Now, if you're a directional trader in terms of calls, puts, and spreads, you do not here want to go after calls and puts. You do not want to go after calls and puts and buy options that are the most expensive they've been in a year on anything. The problem is, if, for example, if you were to buy a put on Aflac, which is tanking at the moment, and the IV is the highest it's been in a year, and the stock recovers, the IV will come crushing out and you're going to get nailed. You do not buy calls, puts, or even straddles. You don't go long. Vega by buying options. Don't buy options when the IV is so expensive. But you can, if you want to go directional, go after vertical spreads. Let me do this for a little bit. I don't do many vertical spreads. Let me rephrase that. I don't do vertical spreads. I don't buy them anyway. But let's go ahead and just run it. And let me show you what I'm talking about. So let's go ahead and search for let's do put vertical spreads. Oops, hold on a sec. I got to get the list here. I want my stock list, which has the most expensive options. And there aren't any on my stock list. We could try bullishly as well. Buy a call spread on gold, for example. My stock list again. I know gold's going up. We all know that now. And there aren't any that come up. Here's the point. If you want to mitigate the potentiality of IV dropping and crushing your long call or put, you can go vertical spreads. So a call vertical spread is buy the lower call, sell the higher, reduce your cost, and mitigate IV crush because you're buying and selling IV. So that neutralizes it to a pretty high degree. And the same thing on puts. A bear put spread is buy higher, put, sell lower. So by selling the lower put, you're also selling IV, buying IV, and that flattens out the impact of an IV crush. So that's one thing you could do. But I like, and we've got 83%. I haven't shown you this yet. Sorry, Gerardo, I know you're trying to timestamp this, but you know we've got an average APL of 9.6%, 83% wins using credit spreads. So that's what I like. That's what I like to go out and get. So let's go ahead and look for some credit spreads. Searchers, single strategy. Let's go after call credit spreads on the biggest 5 high IV stocks. We'll go to my stock list. Now, when you do this credit spread ranker, use this one here. Default parameters short term. That'll sort by probability of profit. And I hit search. What do we got? None came up in the search. Okay. Well, let's try on the put side. Search. Now we know gold. Hopefully, gold is in this list. That's not even the right list. Oh, make sure you select the stock list, my stock list, search. There's gold, baby. The market's open in about 2 minutes. Let's prep ourselves for gold. GLD. What's gold doing pre-market? Looks like it's going to open up. We closed on Friday at 183.77, and currently GLD's at 184.28 or so. So the next question becomes, where do we want to sell? So the idea here would be sell your put spread where you don't think the stock's going to make it back to. Now, the closest I would get would be 180 right here. So that's a round number of support level. It's well beneath the bottom of the gap here. We are up a little bit, as I said. So selling here would be reasonable, but certainly less would be, in my mind, better. And so 176, 177 maybe, but 176 has support protections at 182, 180, 178, and then 176 itself. So that's where I would like to sell for probability. And given the price is roughly the same as what it was, we could start here and we can go through this list. So the other thing one thing to keep an eye on is, you know, look at these, the days in the trade. Do you want to be in gold for 28 days? No. 14 days? That's better. Now, this 14-day trade, and let me tell you why. If you're in the trade for 28 days, you're going to get more credit because you're selling 28 days of time. You'll get more credit than you will on a 14-day trade. But you got to wait 28 days or close to realize the profit, unless gold really takes off to the upside. And while you're waiting 28 days, the banking sector could just completely recover, and the markets completely recover, and the US dollar gets stronger and gold tanks. So I don't want to be in this trade for more than a couple of weeks. So that's the one I would start with. The short put that's shown here is 181, 180. Let's grab it and let's move it around a bit. Let's get ourselves some options. I'm assuming that the prices will be roughly the same when the market's open. We'll look at the live prices here in a minute. All right, so this one's at 181, offering 56% with a probability of profit of, let's call it 70%, 69%. All right, that's not bad. 56%. This might sound crazy, but that's too much. That's too much for me in a credit spread. So then I'll duplicate it, and then I'm going to drop the strikes. You've seen me do this before. Let's try 176. Can we get one for 176? There's